Hello, my friends. If you are watching this video, I hope that you are safe. I hope that you are healthy. And I wish the same for your families and for your friends. I get asked a lot of questions about the housing market and about the commercial real estate market in South Florida and about what trends we are seeing on a national, on a local, and state level and how things are progressing. So I've decided to create this brief video to give you a presentation on the housing market and on the commercial real estate market and some of the things that we are seeing coming out of the last 4 weeks. So I'm going to share my screen so that I can get started with this presentation. I've decided to call this Beyond Uncertainty because we have been in a period of uncertainty for quite some time. There's still some of that left, but now that all the parties involved, and I mean, the governments at a state, national, and local level are looking to address how we're going to phase into a new normal. I think it's time for us to look at, how the housing market and the commercial real estate market is going to move beyond this level of uncertainty. The first question that we get asked is about a recession. Um, the short answer on that is yes, we are going to have a recession. The economists will tell you that a recession technically is when you have two consecutive quarters of loss of GDP. And it looks like we are on our way there. I don't think that you can find any economist that doesn't believe that we will definitely hit those numbers. But a recession does not necessarily equal a housing crisis. Now, I want to tell you, this is not a Pollyanna presentation. There's going to be pain. There's going to be pain in some sectors more than others. And it is important for us to look at the reality and look at the numbers so that we don't exaggerate the pain, but we also don't ignore it. So when I'm talking about a recession not equaling a housing crisis, what I want to present to you is what do we know about the housing market before we entered into this COVID-19 shutdown of the economy. Number one, it's important for us to understand that this is not something that was created by the housing market, as opposed to the housing crash that happened in 2009. So it's important for us to look at where is the housing market, or where has the housing market been up to now, and how we compare it to the housing crisis and the housing bubble. So if you look at the 6 years leading to the housing crash, you're going to see that there was great increases in appreciation. All right. So there was an overevaluation of properties that we all saw. Those numbers may pale in comparison to how they were in Florida and how they were in Miami. For us, the downturns and the upturns are usually a little bit more exaggerated. But if you look in the last 6 years of our housing market, our growth has been in keeping with a healthy, balanced market, which has been roughly around 5% increase of appreciated value on properties. All right. So there hasn't been incredible extremes. The other side for us to look at here is if you look at the mortgage credit availability index, this is basically an index that is addressing how easy it is for a consumer to acquire credit. Now, during the housing bubble, this number was stratospherically high. It was over 850 points because it was very easy for people to acquire loans. This is a time when you could acquire loans without verifying income, without verifying assets, without verifying sometimes employment. It was a sign and get the loan scenario. If you look at the years from 2008 all the way to today, that number has been very well balanced. So you might say to me, well, if it was easier, if it's not as easy to get a loan as it was before, why would that be? Why would that signal something positive for the housing market? Well, it signals to the point of stability, which is very important. We have had a very stable mortgage market. We have had a very stable housing market up to now. The other point to address is the fact that where we have been before COVID-19 and before this shutdown of the economy is we have been in a seller's market. We have in the majority of the areas around the country, and we have seen it specifically here in South Florida, we have been in a seller's market. We have had less than 6 months worth of inventory in a lot of our areas. In some cases, we have had less than 3 months worth of inventory. So we have not been oversaturated, and this is a simple, economic equation of supply and demand. So we have a high demand of product. We have buyers that have been interested, that are ready to buy, and we don't have enough product to provide for them. And this also goes to the point of we have not overbuilt in the last 3 years. In 2017, developers and construction kind of halted their development because some felt that they were going to overbuild. Well, in fact, the opposite occurred. Because of that slowdown, we have underbuilt. We have a higher demand for housing than we have housing available. So therefore, we are at a point in which the lack of inventory has really allowed for there to be for us to not have an oversaturated market. Okay. Now, you look at the amount of equity that has been cashed out. All right. This is basically money that has been refinanced and cashed out in billions. And one of the things that you'll notice is in the years prior to the housing bubble, we had over $824 billion refinanced and cashed out. If you remember, a lot of people would buy a property, they would refinance within a year, they would cash out the money, and they would use that money to maybe buy another property, or they would use that money to spend it in any way that they saw fit. If you look at the last 3 years, that number is about a quarter of what it was in the 3 years prior to the housing bubble. In other words, people really are not refinancing and cashing out their equity, which leads me to the next point, which is that there is a lot of equity in properties, which is not something that we had before. Over 53% of properties in America have over 50% equity. If the property is worth $500,000, that means that they have over $250,000 in equity. If you remember, one of the problems that we had during the housing bubble is that the prices were, saturated. In other words, the prices were propped up higher because it was easier to get a loan. And then people maximized the amount of money that they were able to take out of that property. They basically cashed out their equity. So when the market hit a skid, very easily people got underwater. Basically, they owned property that was worth less than what they owed on the property. So this is not the case today. And this, again, speaks to the health of the market leading into this. Again, I'm not saying that there's not going to be some short-term pain, and there will be, but the fundamentals are on the side of a housing market that, instead of being the cause of the issue, is going to be the reason why we get out of the economic recession. They're going to be one of the leading indicators out of getting out of this economic recession. This is another way of explaining the percentage of equity. There's an average of $177,000 of equity of mortgage homes across America. Now, here is the X factor, right? The X factor is unemployment numbers. We've discussed it, ad nauseum, I think, in the media, and for good reason, because if you look at unemployment numbers throughout the years, even hitting back to the 1970s, now you're looking at an incredible spike for a very special, specific, unexpected, incredible black swan event that happens every 100 years, perhaps, that all of a sudden you have 3.3 million people between March 15th and 21st applying for unemployment. Then you have 6 million plus people the week following, and then that number has continued to grow. Now, where do we expect that to fall? Well, this based on the evaluation of the last 3 weeks. If you look at it historically, and you look at, for example, in the Great Depression, there were 4 years where unemployment was about 20%. The first year it was 15.9%, which was 1931. And basically, in the Great Depression, this came gradually, and then it sustained itself. That's not what people are expecting today, although they are expecting, according to people like Goldman Sachs, a projection of about a 15% unemployment rate by the time we get to the end of the year. They're accounting for, let's see what happens when the PPP programs are in place, when the EIDL disaster loan programs are in place. What happens in the third and fourth quarter when we get back to some level of normalcy? What happens to all that pent-up demand, and what happens to the rehiring practices of firms? So we're looking at short-term pain, but historically, there really is no direct relationship between unemployment rates and and home sales activities, right? So in essence, home sales continue to grow through periods of time in which we've had 7.5%, 6% unemployment. If you look at item number 3 there, that 9.6% was right around the time of the housing bubble market. It's the only time that you see a dip. And the reason why you see a dip is because it was led by the housing market. The other aspect to mention is whether we're going to have a quick recovery or we're going to have a long, prolonged recovery. This idea that people mention about having a V-shaped economy, a recovery, or to have a U-shaped recovery. So many people are projecting that we would have a V-shaped economy recovery, which basically has more depth and less length. Other economists feel like we're going to have what they call a W-shaped recovery, in which we're going to have a V-shaped recovery, then we're going to have another correction, and then we'll have another recovery taking us into the next couple of years. You know, we'll have to wait and see. A lot of the people that fall into the category of having a V-shaped recovery are Goldman Sachs, JP Morgan, Morgan Stanley, Wells Fargo, and we'll see what, in essence, you know, we're going to basically see that the proof is in the pudding. We'll see how the economy, you know, what the trajectory is. But these individuals and the leaders of these companies have access to a lot of data, and they have access to a lot of historical understanding of how, you know, how things transpire from a recession into recovery. I'm going to provide this for you so you can have it. I'm going to make sure that it is attached so that you can see it and read it at your own convenience. But basically, this is a quote from the chief strategist of JP Morgan Chase. And then this I find interesting because what Goldman Sachs is in essence saying is that everything that the Fed is doing, everything that the Treasury is doing, that if they manage to actually thread the needle between the continued virus control and the gradual reopening of the economy, which includes all of the programs from the CARE Act and everything that is continued to be debated, that the level of GDP should begin to move higher in the months ahead. So, but again, the key factor there is threading a needle is not always easy. So we'll see exactly how that transpires. I wanted to show you this because this is a survey of 50 CEOs across different industries by PricewaterhouseCoopers. And one of the things that I found interesting is that when they first did this survey of the same 50 CEOs on March 15th, 66% of them felt, oh, we'll probably go back to normal. You know, we'll get our companies back to business as usual within 30 days. That number decreased dramatically on March 29th and then decreased further by April 14th. And by the time we see the next segment, which will be the April, which will be at the end of April, then I think that that number will be significantly smaller. What I wanted you to pay attention to is that there is a consistent across the board expectation by the majority of these CEOs that once the economy opens up, and I know that that's a big if, but once the economy opens up, then we're going to begin to see a 1 to 3 month a period of time until the businesses get back to business as usual. So I will update this and send this out to you, but I wanted to share with you because I thought it was interesting to see that timeline. I mean, if we begin to open up by the middle of May, and we'll start to see that trajectory, then we're looking at how that third quarter and fourth quarter are going to be for our businesses. Now, on the commercial side, I wanted to just briefly tell you, I'm going to share with you what the near-term impact and what the long-term impact. This should come as no surprise to anyone, but basically the near-term impacts are going to be on properties that are housing the businesses that are most subject to the shutdown. So of course, any travel-related uses, so we're talking about the hotels, we're talking about the airline industry, we're talking about the convention centers, anyone that houses a venue, concert halls, stadiums, all of these are affected directly. So anyone who is housing those businesses, like the shopping centers and the hotels, are going to obviously have the largest near-term impact on their bottom line. The next one is, as in any recession, is basically impacts that are felt by land users with the shortest guaranteed tenancy. And what I mean by that is, if you want to really know who's going to be affected the most, look at what is the timeline of their guaranteed rental periods. Basically the leases that they have signed with people, what is their guidelines? So if you look at the list, if you're following that thread, right? If you're following that logic, the list really begins with hotels and hospitality, because their period of guaranteed tenancy is really at night. You rent the room by night, and so therefore they have a short period of tenancy. Parking lots and parking garages are other ones that are rent the space by hour, or they rent it by the day or the half day. Again, they have the shortest amount of tenancies, so they're going to be impacted the most. Then we look at multifamily apartment buildings for a couple of reasons. Number one, a lot of people have lost their jobs in the service sector. A lot of the people that, that's a big part of the tenancy base for a lot of multifamily apartment buildings. And they have a short tenancy period that is usually a year or less. And sometimes many of these apartment buildings, especially the smaller apartment buildings, they have tenants that are month to month. Now, the reality is that in April, when April began, a lot of these multifamily apartment owners had about 25 to 30% of their tenants having difficulty paying. But by the time they got to April 29th, that number significantly reduced to 11%. So nationwide, landlords were able to collect 89% of the rents for these multifamily apartment buildings. We'll have to see what happens in May and what happens thereafter, but people are always going to need a place to live. And obviously, based on what I mentioned before, we have a shortage of housing. We did not overbuild, which it's actually a good thing right now, because we are, it will be extremely beneficial to not only the multifamily apartment owners, but anyone that has a house that they want to sell or an investment residential property that they want to sell. Third on their list is retail. Now you might think, why isn't retail at the top of the list? I mean, you have businesses that are non-essential, therefore unable to open. You have tenants that are having difficulty making payment. But again, going by the logic of the longest guaranteed tenancy, retail has a lengthy tenancy period, usually 5 years, 3 years. So therefore, you have a little bit more of an expectation of rent coming due. And I know that a lot of the retail landlords have really gone above and beyond, for the most part, in trying to work things out with their tenants. And it's been a mutual work between the two parties, and for good reason. Then we get into office. Again, office rents are usually a longer period of time. People rent big sections of office space usually for 5 years. I'm not talking about the small, short-term, or the co-working spaces. Those are going to be affected the most. But the professional corporate office buildings that have longer tenancies have a little more insulation. In fact, as of April, 90% of all tenants pay their rent for office rent, not only here in the United States, but nationwide. I mean, internationally. And lastly is industrial. Industrial seems to be one of the asset classes that is going to be most insulated as opposed to the other ones. Number one, because they have the longest tenancy period, but also because of different trends that were already occurring that are going to be accelerated in the months forward, which brings me to what the long-term impact is likely to be. So anything that was already a trend, okay, that maybe was in its nascent stages and its initiating stages that people were, slowly adopting, it's going to be accelerated by everything that we have been, forced to do over the last month and a half. So for example, e-commerce was already a trend, right? We already had the Amazon effect, but now this retail evolution is going to be accelerated. We have had with companies like Instacart, the delivery of groceries. Whole Foods has done delivery of groceries with Amazon Fresh as well. Publix has utilized Instacart to do deliveries, Walmart and the like. That absorption, that subscriber rate just has skyrocketed, right? Because people have decided, well, if I'm able to get the food and delivered home, and I don't have to go to the store, then that obviously right now is of an incredible value. So we're going to see that those people that are adopting this are going to stick with it, and we're going to see those trends accelerate. Which brings me to Logistics 2.0, which this is basically, and by the way, I want to give credit. This is stuff that I have absorbed from different economists and different presentations that I've seen and research that I've read on, so that I can put it in a way that is presentable to you and so that it gives you some pointers. Logistics 2.0 speaks about the industrial spaces and how they're being utilized, how they will be utilized in the future. And there is a focus on last mile facilities. So first, let me tell you about logistics. And I'll say it by giving you a practical example. If you have a distribution center of 500,000 square feet, and you had to shut it down because you had 2 or 3 people with COVID-19 employed in the data center, in the distribution center, you have to now clean, you have to shut it down for 14 days. You have to now stop any production, right, and any distribution out of that center for a period of time, which is very painful to the business. So what a lot of economists and commercial real estate professionals are expecting is that maybe that company decides, maybe instead of having one 500 square foot space, we have 250,000 square foot spaces, or 5 100,000 square foot spaces. So that way, if one shuts down, I'm only shutting down 25%, 1/5, right, of the total amount, or half, instead of having to shut down production and productivity on 100% of the space. And the last mile facilities are basically, the last mile is what is the highest cost of delivery of the goods from the time that you order it until you get there. That last mile to get to your home is the one that costs the most, right? Because everything else is very efficient when you go from point to point. But in that last mile delivery, that last delivery has to stop in multiple places. So last mile facilities are facilities that are located in places of high density and that are surrounded by consumers that are buying a lot of the e-commerce goods, right? And they basically evaluate that based on the amount of in terms of dollars that are spent by everyone around the last mile facility for the delivery of these goods. So there's going to be a greater emphasis on these facilities. The other one is, of course, telecommuting and office leasing. I'm doing this presentation at home. I'm using Zoom to create this presentation. I'm involved in meetings and board meetings and communication between one client and another based on this manner. And this is something that a lot of businesses have realized, that their greatest fear of having or allowing people to work from home is that there was going to be a reduction in productivity and efficiencies. And they have been surprised in that the opposite has been the case, that there has been an increase in productivity and efficiency. And how does that affect office leasing? Our company's going to need to have a bigger space, a smaller space. This is really there's not a direct answer to this, because I could tell you right now that everyone that is getting ready for what the guidelines are going to be in heading back to work, the word that they're thinking about is density, right? They're thinking about, how is it that I'm going to reduce the density in my office? So if I have 40 employees, maybe the answer for me is I'm going to keep 20 employees working from home like they have been doing and telecommuting. And then I'm going to have 20 employees, because I'm going to be able to separate the desk, give that 6-foot distance. And then the employees that come in, and I could have them in different rotations, right? But the employees that come in are going to be there because they need to be there. And I'm going to make sure that I protect them. And future, and maybe not so distant future, there's going to be great emphasis on air quality, UV lights at the office, all of these things and of course, having sanitation stations and all those things, and making sure that people don't come to work when they're sick. The fourth here is suburban interest. A lot of people have been staying in their home. They live in the suburbs. They work in the urban core. We've had a trend of people moving to the urban core, of people working out of the urban core. They want to be in a place of high density, walking around. They want to have that experience. However, now that they are here, they are looking at office spaces, for example, that is closer to home, that they can utilize anytime, that it's going to be less expensive. So we believe that there might be an absorption of some of that product that is in the suburbs, and that will apply to interest in multifamily buildings in shopping centers in the suburbs and industrial space as well. And the last thing is adaptive reuse, which is something that has already been going on. If you have ever been to Wynwood, you have seen, warehouses that have been shaped and reshaped into being retail stores, into being restaurants, into being entertainment venues. And so that is all the result of what we call adapting the use of a product into some other use that it was not its initial intention, right? So how are we going to adapt? Will there be some adapt to the use of shopping centers when this is all said and done? We've had a trend over the last 20 years where maybe 20 years ago, a shopping center wouldn't have more than 11 or 17% of their space occupied by restaurants because they had a high, historically, a high level of failure, right? And so, landlords don't want to have empty spaces. But that has changed dramatically because of e-commerce and because of the retail e-evolution, where people wanted to go to the shopping centers to have an experience, to have, it's been this focus on experiential retail. And so therefore those numbers have increased from 11 to 17% to a 40 to up to a 40, 45, up to a 50% of the spaces are occupied by restaurants. How will that change moving forward? Lastly, what I want to say is that, look, this was just kind of an overview. I wanted to give this to you. But I think it's very important that when you are evaluating your property or maybe your plan to purchase something, that we have a chat one-on-one. So I know we have this physical distancing, but we don't have to be socially distant. I would love to get on a chat with you. So I'm inviting you to book with me a 15 to 30-minute session. In it, we're going to discuss how's the market on your specific market, discuss your asset class, discuss ways in which the market is functioning. Take a look, more importantly, behind the scenes at the MLS and behind the scenes at the inventory of product that is out there. I think there's going to be information that is going to shock you. A lot of people believe that there's going to be reductions in price, but right now, and we've been monitoring this on a 2-week by 2-week by 2-week basis to make sure that we have the latest information possible. The reality is that we have not seen price reductions. In the entire United States, only 3% of properties of real estate properties have seen a price reduction. What we have seen is some people pull properties off the market because either for safety reasons they didn't want to be on the market, or because they were concerned that they would be negotiating at a time of such great uncertainty. Then we've had properties that have been off market because they have been under contract that have re-entered the market. And then we have had properties that have been, but what we have not had, pardon me, is a reduction in, we haven't seen prices drop, and what we are seeing, even though pending sales, were reduced significantly over the last, over the last 4 weeks or 4 weeks and 3 weeks ago, in the last 2 weeks, we've seen an increase of 67% of pending sales. So some of those properties that went back on the market because the contract fell through because of all the complications of COVID-19, a lot of these properties have already been under contract already. The last thing that I would say is that one of the things that I like to monitor is what I like to call the shadow inventory. Well, I don't like to call it. It's known in the industry as shadow inventory. And basically what it is, especially for those of you that are looking to purchase something, what it is that the properties that were on market and that have been pulled off market, those owners still have an interest in selling, but they pulled the market off the market either because they were concerned about health, they don't want anybody visiting their properties, or they were concerned about negotiating from a position of weakness. So, because of the relationships that I have been able to build with other brokers, then I have access to those properties to find out if in fact those owners have an interest in selling, and hopefully reintroduce the property into the market to you directly before it hits the market at large. So again, I want to invite you to schedule a chat with me. But as always, regardless, I'm always available for you by phone. Text me, call me, send me an email. Let me know if I could help you in any way. I want to stop sharing because I want to be able to just finalize by saying I want to find a way to make it easy for you to book these sessions. So I'm going to set something below so that it will be easy for you to set it up. And then we can chat one-on-one. I'm really looking forward to you. I would love to be able to see your faces and see how you're doing. So I want to encourage you to do that. But again, as always, I'm here to help you in any way that I can. It doesn't have to be real estate related. I have been very thankful. I'm very grateful that I have great relationships with different leaders in different industries in South Florida. So if there's a way that I can help you in any way, please don't hesitate to reach out to me. God bless you and take good care of yourselves.